All right, so we'll get started. If anyone else joins along the way, I'll be sure to let them in. Okay, so what this webinar is going to be focused on is, I would say, I'm just shining a slightly different light in terms of how we understand certain market concepts. And this is not going to be overly heavy on Elliott Wave necessarily. We obviously can't get away from Elliott Wave whenever we're discussing market movements and trading. But what I really want to focus on is a slightly different concept today. So what I have before us here, right, is something that we're all quite familiar with, which is an idealized Elliott wave diagram. And I've got this down so we have the subwaves for waves, 1, 2, 3, 4, and 5 as well. Now, one of the issues that I'm seeing quite frequently with Elliott wave traders, and in fact, this issue isn't unique to traders using the wave principle. This issue is going to apply to traders using no matter what technical or fundamental methodology out there. And that issue is there's always going to be a degree of subjectivity when it comes to market analysis. So, for instance, you might be counting a 5-wave impulsive advance, whereas somebody else might see it as a complex corrective sequence, right? And of course, one of the biggest edges that I think Elliott wave analysts have over everybody else is the ability to have alternative counts. Okay, there's very few methodologies out there where people can come up with a plausible alternative view on the market and then come up with like a plan B if plan A doesn't go exactly according to plan. Okay. Now we've all been there where we're looking at a piece of price action and it's like, I just don't know how to count that. And I like to frequently say that, look, you put any chart in front of me, I'll find a way to put labels on it, but that doesn't mean that I'm very confident in the count itself. Now, I do believe that with the benefit of hindsight, the market's always going to resolve itself in such a way that you can say, well, that was obviously the right count, even if it's not particularly textbook. So I'll give you an example. So for instance, if we have like a 5-wave decline like this, what we would expect is a 3-wave retracement going up to about 61.8% of wave 1. We all know that. That's the standard wave 2. But sometimes you'll get this. And you have a tiny wave 2 that doesn't really fit the characteristics of what you would expect to see as a second wave. In fact, you would probably see this more as wave 2 of wave 3, right? Or even wave 2 of wave 1 of wave 3 if we're getting quite granular. So the point I'm trying to make is that subjectivity is oftentimes something that we painfully struggle with. Now, I used to say, and I still believe this applies to beginners, especially, is that if you want to trade using the Elliott wave methodology as the foundational cornerstone, if you will, of your trading plan, then stick to those textbook counts that you have extremely high confidence in. And I do believe that's true. But the reality is that those counts are few and far between. I mean, if we only traded textbook counts, we're going to have far fewer trades. And that's probably a good thing, right? We all know that quality is far better than quantity. At the same time, we also have to be realistic about what we want to get out of our trading. If you trade only a handful of A-plus textbook setups per year, are you going to be taking outsized risk on those setups, knowing that you're not going to get as many of them? Well, to me, that doesn't sound very palatable. I don't like taking outsized risk. So what I was really curious about was seeing if there's a way to take several trades over the course of a week, sometimes even within the course of a day, regardless of whether the count is quote unquote textbook or not. And this is where I started to go back into some Wyckoff theory, which I had studied earlier on in my trading career. And Wyckoff also has a high degree of subjectivity to it. And that's when I started looking at what other traders are doing. And over the last few years, there is an individual called the Inner Circle Trader. He goes by ICT on the various social medias. And he's developed his own methodology, which is not, I'd say, entirely proprietary. It borrows a bit from this, it borrows a bit from that. And then there is some stuff which I'd say is more or less unique to him. Now, here's the thing. I don't think there's anyone out there that can say they've cracked the code on trading. I don't think that's possible. But I did see some things in his methods that made sound technical sense to me if they were just slightly tweaked and adapted a little bit, right? And then from the ICT trader emerged this very popular concept called so-called smart money concepts. Now I'm going to blow apart smart money concepts in just a minute. Um, but the idea behind SMC, as it's more commonly known, is that the old school methods of technical analysis are now obsolete. Institutions have caught on. They're targeting those old school traders. So for example, trendline support and resistance traders, they would draw a trend line. Normally people would short the market here. They'd get a really nice profit, and then they'd collect their winnings, and their trade could look something like this, for example, right? And then what the SMC traders will tell you is that the trendline break is simply meant to induce dumb money into the market so that the smart money, the institutions, can take the other side. And in fact, their trades will look something like this. The reality is that smart money concept traders, ICT traders, Elliott Wave traders, support and resistance line traders, supply and demand traders, they all fail for the same reasons. And it's that they're grappling with an incomplete understanding of the market. So what really drives the market? If we step away from the Elliott of it all for a second, what really drives the market? And the answer is incredibly simple. All it takes to drive a market is for two people to agree on a price. Right now, if we take the number of us that are in this, Zoom meeting right now, and we all agree, let's all make up a brand new cryptocurrency. We'll call it the whatever coin. And if we all agree that whatever coin should be priced at $100, guess what? Whatever coin's going to be priced at $100. And all it's going to take is for two people in this room to agree independently that whatever coin should instead be priced at $102 for the market to move. And then it's up to everybody else to agree or disagree on that new price. So all the rest of us might agree, you know what, 102 is not right. Whatever coin should be priced at $110 instead. And that's how a market moves. In other words, it takes liquidity for a market to move. Now, in this idealized Elliott Wave diagram, there are buyers and sellers galore. We have buyers buying in wave 1, we have sellers selling in wave 2, buyers in wave 3, sellers in wave 4, buyers in wave 5. And then within the substructures of those various waves, we also have buyers and sellers. So what happens here, for example? Let me just change the color of this. So what happens right here, right? As the market is trading higher in wave 5 of wave 1, and wave 5 eventually comes to an end. What's happening is that there's going to be a number of people that rode the market up who are now exiting their long positions. How do you exit a long position? Well, you have to sell it back to the market. So they're effectively going short. Not effectively, but you can think of it as a simplified version of them putting some selling pressure into the market. And then you're going to have people who are actually going short the market. And not only do they think that the run is over, but they think the market should head lower. And they're going to make a speculative bet on that fact. And then you're going to see the market trade lower as well, right? So we're going to see this run of liquidity, right? So as the market trades lower and lower and lower, what you're also going to see is people who bought. Maybe they bought right here. Maybe they bought it right here. There's going to be a bunch of people that bought at the very top. As the market goes lower, they worry that their view of the market was wrong. And so they take a loss and they sell back their positions as well. And what eventually happens is when all the stop losses have been quote unquote run, when people don't think the market can go any higher. Notice I didn't say lower. When people think the market can't go any higher and the field is cleared, that's when new buyers are going to step back into the market, right? So although this is an idealized diagram, this phenomenon is extremely common. We've all had this happen to us. We've all seen this in real time, where you have your stop loss below the low of wave 1, the market takes up that stop loss, and then it starts trading higher. Right? We all know what that feels like. It doesn't feel good. So what does that mean? It means that there was liquidity right here that was grabbed, clearing the field, leaving the door open for the market to trade higher. The same thing happened right here. Okay. And the same thing in reverse happened right here. The market went higher, inducing more people to buy. Those people got stopped out. And then as we're breaking this low here, everyone's getting excited about the downside, and you have a lot of people exiting further long positions, maybe the folks that bought down here, and they don't want to see their position go to zero, so they'd rather take a limited gain now. And you're also going to have some people actively shorting the market as we break below this low, right? And then all those people get stopped out, and then the market takes off, right? This is how markets move. Yes, it's all within the Elliott Wave diagram, but the driving force behind it is liquidity. Okay, so where am I going with this? Well, what I wanted to do was come up, like I said earlier, with different trading strategies that allow me to trade multiple times over the course of a week or multiple times in a day, right? And we're going to get into some practicalities and we're going to go to real charts in a moment. I just really wanted to set the stage here for that. The other thing I wanted to do is what I've realized is that some of the entry models that traditional Elliotticians use just aren't very efficient. What do I mean by that? Well, we all know here, for example, that we have a five-wave movement, 1, 2, 3, 4, and 5. And we all know that this is an ABC pullback, A, B, and C. So our traditional entry model is to buy on a break of wave B, put our stop below the low of wave C, and then we'll look for like 161.8% move up in wave 3. But that's just not practical. I feel like this risk that we're taking doesn't always have to be that large. I feel like we can take tighter risk at times, dramatically improving the profit factor potential of a trade. And that's exactly what we're going to explore. Now, I'm not saying this entry is wrong. I'm just saying that I think there is a better preferred entry that I like to use, and I'll show you that entry in a moment. And if I don't get my preferred entry, then I'll decide whether this standard entry is worth the risk or not, right? Okay, so we're also going to be exploring that as well. Okay, so there are a couple of concepts that we need to go over right now first before we go any further. So there is some terminology here that I'll be using, and the new term is going to be inducement. So there is some like ICT and SMC jargon that I'm going to stay very, very far away from. So if you've heard of order blocks, if you've heard of kill zones, if you've heard of silver bullet strategy or breaker blocks, we're not going to be talking about any of that. We're going to be talking about order blocks. We're going to be talking about inducements and order blocks. Those are the only two new pieces of vocabulary that I'm going to be introducing here. So first off, what is inducement? So inducement is, the technical term follows also the dictionary term. It's when the market is enticing people, drawing them in to take an action one way or the other, right? And here's an example of inducement. Okay, so what do we have here? Classical chartists see a head and shoulders pattern, right? Support and resistance traders see a break of support here where they go short. So in other words, this setup is inducing traders to go short, right? They might place their stop up there. And they could be targeting lows all the way down here, right? That could be what they're looking for. What happens? Well, as Elliotticians, we see this as a three-wave movement, and we're looking for further upside, right? So once the market's been induced to go the wrong way, that's when it sets the stage for what is called the pro-trend move, or the move in line with the higher degree trend, okay? All right, so what is inducement? It's effectively a break of the most recent low or high swing point in the run that you're looking at, in the trending movement that you're looking at. All right, that is the simple definition. Okay, so it's impossible to really, or not impossible, but it's a lot more practical to look at inducement in real market terms. So I've just got a couple of, and today was like a really good trading day actually. So I'll show you a couple of examples here in terms of how this entry model works. Okay, so Cable, if I'm looking at the move from overnight, my time overnight trading in Eastern time, what we saw here was a clearly impulsive run, right? So there was a clearly impulsive run to the downside here that happened in overnight trading. So from the early, I'd say the hour just before the London Open. Okay, so we have a clear 5-wave movement down, and then we had this larger 3-wave structure to the upside. Now, if I wanted to trade the break of wave B, then I'd be placing a sell order here. My stop loss would be up here, and my target would be like down here, right? So if I actually assume, let's just assume that I caught bottom tick the markets run by close to 10 a.m. Eastern, I'm getting 1 to 9 on my trade, which is good. That's really good. I mean, that is a good result. That is a result. But, as you'll see, I almost got 5 to 1 on this trade, and I was in and out in a matter of minutes. I was in right around 8:07, 8:08 a.m. my time, and I was out by 8:19 a.m. Okay, so how? Why? Well, I saw this. I didn't want to take the break of this because I figured it was too much risk. All right, what can I expect at 8 a.m. as the New York session opens? I can expect a fairly volatile run as a number of orders get input into the market, and that's the move that I was trading for. Yes, if I was a lot bolder, I could have gotten, 17 to 1, sure, whatever. That will happen from time to time. That is not my expectation for anybody to be hitting those kinds of trades on a regular basis. Okay, so what am I looking for? Well, if I wanted to count this, it does get a little bit messy. So suffice to say, I don't really care how you count this, but this is our impulsive move. Whether you want to say this is the end and here we have an A, B, C for an expanded flat, or whether you want to take the impulse all the way down here, I don't care. It doesn't matter. The wave count is secondary. What is primary, or I should say this sub count, the sub waves of the count are secondary. What is primary is that I see a 5-wave decline followed by a 3-wave advance, counter trend advance, and I'm expecting a fresh 5-wave decline. That's what I'm trading for. Okay, so this is my inducement level. Why? Because this is the most recent swing high before we made the most recent new lower low. In other words, this is probably wave 4, and this is probably wave 5. Okay, so remember one of our guidelines. Wave 4 tends to where does the fourth wave end? It tends to end near the terminus or the origin point of the prior fourth wave of one lesser degree, right? Now we can that guideline is something that's been in my head for a really long time, and I was thinking like, well, why is that? Mechanically, if we think about that, why is that the case? And the reason is because that's where liquidity is. Right? So we needed a run on liquidity here to induce buyers into the market. So as we're getting out here, look how excited people are. We can visually see that in this large body candlestick here as buyers rushed into the market. And then we had more buyers rush into the market. Why did the market stall here? Well, because we have an order block. So what is an order block? An order block is effectively a number of resting or pending orders in the market, limit orders. So in this case, we had a number of sell limit orders in this area, which is what allowed me to take that entry. Okay, all right, so cool. How did I identify this order block? All right, so an order block, there's two types of order blocks. There's, if we want to get technical, there's order flow, and then is a single candle order block. So an order block, like I said, is that block where there is a number of pending orders. Now, this is the last bit of counter trend price action, right? Before we made this low here. And then we came up, we put in this swing high, we made up, we came up, we put in a new low. So the order block I'm looking for is the last section of buying power in the market right above the inducement level, right? So this is a collection of, well, here we have a bullish candle followed by a bearish engulfing candle, and then we have a few small bullish inside bars here, and then we get the bearish run, all right? Now, this area is also unmitigated. What does that mean, unmitigated? Unmitigated means that prices haven't tapped into this area yet, okay? So if prices have done this, then made a new low, then we can say that this order block has been mitigated, and we'd have to draw a new order block here. And that would be our fresh, unmitigated order block. If you have any questions, feel free to unmute and just ask me at any point in time, all right? So this is our unmitigated order block, right? It is the last collection of buying power in the market before immediately preceding the inducement, okay? Now, I'm going to go over more sophisticated entry models in the future, but you can sell directly as prices tap into this piece of order flow here, bearish order flow, which is more or less what I did, okay? I was late to the party by a few minutes. I was literally firing up my computer just a few minutes before 8. So I lucked into a slightly better entry than what I would have taken, okay? My real end, if I was being very strict with my trading rules and I'd set my sell limit, it would have been right here. And my target would have been the same. So instead of 4 and change, I would have gotten 3 and change out of this trade. Still a great result either way, especially in a matter of minutes. Okay, so why am I targeting the prior low here? Well, for a couple of reasons. One, I didn't want to overstay my welcome in the trade. I wanted to get paid and get out so I can move on to a couple other things with my day. But also, this is where I have to assume that there is some buyers waiting. Why is that? Because their stop losses are all clustered below this level here, right? So they're going to be defending this area. At least that is my assumption. And we can see that buyers did eventually step in, and then they got caught the wrong way again, all right? So no need to get fancy with the targeting, but if I'm using these inducements and order block techniques, my target typically tends to be just the low or the high of the prior move. I don't need to be any greedier than that, okay? So that's one example of how such a trade played out. There are countless other examples. I believe over the last week, there have been a ton on the Qs, which is the NASDAQ ETF. Okay, so again, here is my inducement. Now, if I'm looking at this, is this a 3-wave move to the downside? It absolutely is. All right. Does that stop me from taking the trade? Well, in my case, yes. I'm just bringing this up as an illustrative example. If this was a clear 5-wave movement, I'd have been far more excited to get into the trade if we had tapped into the order block, which would have been up here. Now, as you can see, we missed that order block and we started to trend lower anyway, right? I just wanted to give an example of what inducement in the market looks like. But here is another good example. So here we're looking at US dollar futures. All right, so here we have our impulsive advance. Here's our inducement. And then here is our impulsive advance. This is where trading options on the futures or on an ETF is very, very helpful because you're not necessarily bound by a price-based stop loss. All right. I don't want to cover stops and everything in this class, but I'm going to show you guys how this works, right? So here's our inducement. Where is our order block? Right here. Why is that our order block? So this is our last piece of bearish order flow within this up market. But what happened here? This wick of this candle mitigated that order flow. So what do? I simply refine the zone a little bit lower. Why? Because this wick ate up the orders in this zone, but the whole zone hasn't been mitigated yet, right? We haven't broken below the zone. So I simply set it a little bit lower. And am I entering blindly right here? No. Why? Because this is where Elliott Wave gives me an edge. This is a single leg move. This is my wave B. This is my wave C. Now, you're going to say, hang on a minute. Shouldn't we expect a deeper retracement where A equals C? Shouldn't we expect prices to pull back all the way down here? Yes, that is certainly a possibility. And guess what? There's another order block right here, right? So that is something I had my eye on. But from my back testing, this is something that I've seen work really, really well, where the first order block, provided you have the right setup, can work very, very well. And what do we have here? on the way down for wave C. 1, 2, 3, 4, 5. So I could count technically a completed wave C, even though it did not follow the guidelines to a T. So why am I willing to take risk here? Because I can get away with a very tight stop, which means I don't need to risk 2% or 3% or whatever it is I would normally risk when I have to take a larger stop to make the commensurate reward worthwhile. Here I can risk 0.25% or even 0.1% or 0.5%, or I could risk the full 2% if I wanted to, right? And just getting back to those prior highs gets me almost a 9-to-1 trade. So what happens if we get stopped out? No problem. Now we're just looking at this piece of order flow here, and it's the same setup, right? So this is not a silver bullet in the sense that you're never going to take another loss ever again. It's just a way to refine the entry techniques a little bit more when you're looking at the market through the lens of Elliott Wave with this understanding of inducements and order blocks layered on top, okay? So now we're going to go over to Aussie dollar, where I'm using a combination of techniques. So yeah, all right, Aussie dollar. Oh, the market's pulled back a little bit. Okay. So on the 15-minute chart, 15-minute. Okay. So on the 15-minute chart, here's our inducement. It's the last significant swing, and then we get the counter trend advance. Okay. All right, so there is one ICT concept I'm going to mention here. All right, it is what's known as an implied fair value gap. Okay, so a fair value gap occurs when you have a fast-moving market like this, right? So you can see here we have this collection. This is a fast-moving market. This is a fast-moving market. To identify a fair value gap, you need 3 candlesticks or price bars, right? You need 3 candlesticks or price bars. And what you want to do is you want to identify the largest candlestick in the range. So in this case, that's this candlestick right here. And then to draw and refine the fair value gap, I need to look to the candle immediately to the left of the largest candlestick in the range and the candlestick immediately to the right of the range. I then draw a zone from the low of the price bar or candlestick immediately to the left of the larger candlestick, and I bring it to the top of the candlestick immediately to the right. In a bull market, the fair value gap would look like this. This is my biggest candlestick. This is the one to the left. This is the one to the right. This is my fair value gap. Okay. So the fair value gap is a concept which I'm still testing, but I found that if you've identified the trend correctly, in other words, in a bull market, you want to be looking for bullish fair value gaps. In a bearish market, you want to be looking for bearish fair value gaps. Otherwise, they won't work. That is a place where prices tend to test and find resistance, right? So this zone here is where I'm looking for prices to enter. So they did enter on the 15-minute chart based on this fair value gap. And then as I'm refining on the 2-minute and 3-minute, I'm simply doing the exact same thing all over again. Here's my impulsive decline. Here's my inducement. Here's my order flow. Enter here, stop loss just above the fair value gap. And I can target the previous low. Right? And then what happened? I also combined this with a standard entry that we would typically use. And I scaled in actually. So the standard entry is, well, here is my complex corrective sequence. X, A, B, C, Y, and then we're breaking down. And then we're seeing something similar here, where this is likely a 4th wave. 1, 2, 3, maybe this is going to develop into a triangle, I'm not sure, but it's another opportunity to be scaling in. Right? So I just want to highlight how, we can use multiple different entry models it doesn't have to be one or the other. If you feel more comfortable sticking with one or the other, that's perfectly all right. This also works very well on higher time frames. So I've been looking at this on like a 1 hour, 1 minute, 2 minute charts, but let's look at this. You know, we can pick literally any market. I will pick a random stock off the top of my head. Just scroll through. Plus therapeutics. Never looked at this price chart in my life. Okay. So what are we looking for? Here is my inducement. Right? That's the last major swing high. Where's my order flow? Last buying order flow before the last selling pressure of the major run is right here. We went up, we went down, we went up. That's my order flow. What happened? Market tapped in the order flow and went down. All right, where are we targeting? We're targeting the prior lows down here. Right. Now, even where we are right now, you know, that's still a great opportunity to manage the risk on the open trade. Okay. If we take a look at stock like Microsoft on the daily chart, we can still do the exact same thing. Here's our impulsive advance. Here's our inducement. Here's our last piece of order flow. Yeah,
so
go ahead.
I actually have a question just for the stock that you just had. Which one was it? I don't really know.
Plus therapeutics.
So I was wondering why that inducement was considered an inducement instead of, hey, we are getting the next impulse here. So is it just because the higher time frame or the higher trend is bearish?
Yeah, I mean, look at this thing. It's never had
Well,
a market in its life, right? So
yeah,
you
I
know now
was
if we go back to the left of the chart, right, we can do the same thing. So here is our last low, you know, in that sequence. Here's our inducement. Here's our order flow. Now, would you have gotten stopped out on this trade? Maybe, maybe not. Probably, you know, for being honest. But the concept still remains the same, if you will, right? So, and this chart's very, very spiky. But yeah, we can see the same thing with Microsoft. We can see the same thing with Tesla. So if we're looking at Tesla, say on a 1 hour chart, just to make things fun, what happened here? Here's our inducement. And now in this case, we didn't make it to the order flow, which is near the extreme right here. We didn't get that far. What happened? This is what's called a liquidity sweep. So a sweep is what happens when we take out the inducement and then immediately we fall back below it, right? So if you're very aggressive on that first candle that closes back below the inducement level, you could set a short order like this and target the lows. For me, that's too aggressive. I found this to be not all that reliable, let's say. But what do I do when there's a sweep? It's very simple. I just wait for the exact same thing to occur. So there's our inducement. Here's our order flow. Here's the trade. Boom. And then you have a nice run lower. Okay. Boeing, also a stock that I haven't really looked at. Well, that count was, I guess it was right to some extent. That's obviously a fifth wave. But anyway, so what do we see here? Here's our inducement. There isn't really any clear order flow here. I would say, yeah, there isn't really very clear order flow here. But after taking out the inducement shortly, the market went back up. Let's look if there's a way possibly to day trade this. Yeah, there is actually. So here's my inducement. Here's my single candle order block. Why is this my single candle order block? Okay, so now we're going to go to another concept. So we've talked about order flow, which is the whole block of price action where you're going to see pending orders. We're now going to talk about how you can apply the same concept to a single candle. All right. So a single candle order block is a candle that takes out the previous candle's stop liquidity. All right. So in this case, we're going to focus on this candle right here. So this candle is our single candle order block. Why is this candle our single candle order block? Well, because it's made a new high relative to the previous candle, and then the next candle closed below it, right? So there's two ingredients that make this our single candle order block. The first is it took out the previous candle's high because we're in an uptrend here, or we're not an uptrend, but we're looking at bullish price action. The second ingredient is that we need to close below the candle's low, which is what we get here, right? So that makes this our single candle order block. So why is this our single candle order block up here? Because this candle took out the previous candle's high here, and then the next two candles, it took two candles, but this candle closed below it. And what we can even do here is we can also draw our fair value gap. Here. You can see the market slightly exceeded the fair value gap, traded into the order block, and then we got a really nice day trade on the way down. Right? So the market doesn't matter, the time frame doesn't matter. It's just a question of looking for these inducements and order blocks. Now, this isn't meant to be a masterclass on inducements and order blocks right here today. This is meant more to show you in broad strokes how I'm looking, at the market and the lens through which I'm looking at the market right now when it comes to trades. Here's another quick example that just caught my eye. Here's our inducement. Here is the order flow. If I wanted to get very specific, here's my single candle order block. If you're waiting for the single candle order block to get tapped into for your trades, you will have maximal risk reward. However, you run the risk of missing the trade. If you're waiting for order flow, you're far more likely to get into the trade, but you're also definitely going to have a lower average risk reward. So everything in trading has trade-offs. Okay. Now, the crucial thing with these techniques is that you use them in the right direction, in the direction of the larger underlying trend. Because what will happen is inevitably someone's going to say, well, here's my inducement. Here's my bullish order flow. Why did I get stopped out? Why did I get stopped out? And the answer is going to be, well, you were trying to buy in a downtrend, right? It's as simple as that. There's no other ifs, ands, or buts about it. You got stopped out because you were trying to buy in a downtrend. Okay, so you're going to see inducements and order flow everywhere, and that's how you can get in trouble. So if we go back to our friend Aussie dollar, I go down to the 1 minute chart, I will see inducements everywhere if I really want to. Okay, so for example, I could say, oh, this is a pretty big bullish move. Here's my inducement. Here's my order block. I'm going to buy. I'm going to set my target up here, get a nice 3.72 to 1 trade. Oh, I got stopped out. Why? Because again, you're trying to buy in a market. However, look at what happened here. What is this? This is our inducement. Where's our order flow? Up here. How can we trade this? Place your stop just above the order flow, target the prior low. Now, I'm not saying you can't target more than the prior low. I'm just saying that tends to be my minimum target on these trades. What happened here? Very similar thing. Here's our inducement. This candle is the last swing point before we get our lowest low here. Here's our order flow. Now, I'm not saying you should have traded this because the risk reward obviously would not have been great, but you would have still had the opportunity, from an analytical perspective, this is still fairly satisfying, right? So again, the key to trading these techniques correctly is to ensure that you're doing them in line with the greater underlying trend, right? This is just an entry technique. It is not a silver bullet to trading the market and never taking another loss, right? But when you combine these techniques with options, I think that's where you're really, really, really onto something, okay? Because what I like with options is that you no longer have a price-based stop loss, right? You have a time-based stop loss. So what I'm experimenting right now is trading zero data expiration options. So in other words, options that expire the same day on these techniques. All right. And I've been doing that with great success. So here's an example in the SPY. So what happened? The market broke the swing low, right? So I'm looking at predominantly bearish price action. Call this a 1 or call this an A. I don't care. Here's my inducement. Here's my unmitigated order flow. Why is this my unmitigated order flow? Because the market broke down and then the wick of this candle came in and tapped it, right? So what do? Fine. I can no longer consider that my order flow. I go up to the very point where that wick ends, and here's my order flow. And then I buy my put. I'm trading my zero data expiration put on the SPY. Very, very straightforward. I don't care about stop loss. I don't care about any of that. And because it's an American style option, I can sell the option out whenever I want to, right? So I'm not forced to hold on to it for the whole day. As soon as the option's worth something, I can potentially sell it back for a profit. So there's all sorts of different and really cool things that we can play around with here when it comes to these concepts. Now, I'm going to give you another utilization for these inducements if you don't want to trade order blocks, okay? So this is something that's really, really cool. So this is on the euro yen currency pair. We're going to look at a 30-minute chart. Was it euro yen? Yes, it was euro yen. This is not a trade that I took. I didn't take the trade because it would have taken place around 3 o'clock my time, right? It's just something that I noticed very recently this week, which is a good example. Okay, so I'm not sure how we want to count this, but it could be a triangle of some sort. Okay. What I'm focused on more so is the fact that here we have a 1, 2, 3. I'm looking for 4 and then a 5. And it's very possible, fine, that this is all part of a larger triangle. That's perfectly fine. Okay, so with these patterns, how do you know the zigzag's over? How do you know the double zigzag's over? How do you know the flat's over? How do you know the triangle's over? One really good filter that we can use is, has the pattern induced other market participants or not? So here I can say, yes, we have. This is my valid swing point. Here we have inducement. So this wick induced the market. We completed out the pattern, and then you can trade for the upside. Pat, you're asking, are there indicators to reveal institutional order blocks? No, there aren't. What you could do if you have access to, so in a centralized market, right? You can look at level 2 data, and that can show you whether or not there are limit orders clustered around certain price levels. Okay, so for example, if I'm looking at the Qs or ES or YM or something like that, let's just say this is my order block. I can go into my level 2 data and see if there are orders stacked in that block there or not. Does that tell me whether they're institutional orders or not? No, it doesn't. Can I take an educated guess based on the size of those orders? Yes, I can. So the answer is no, not like there isn't an indicator that will tell you with 100% certainty, but through reading the tape, looking at level 2 data, we can get a bit better of an idea. I don't have another specific, wait, what is this? I see a target field, but I didn't take this trade. Let me just see real quick if there are any other examples here of patterns where we're looking for, yeah, okay. So this is pretty good. Okay, so here's our impulsive advance, right? And then here's our zigzag. How do I have confidence that the zigzag is real? Well, we've induced the market here. We've induced the market here, okay? 2 is fine. 1 is my bare minimum now for trading these patterns. If there's been no inducement, I just don't take the trade period. And then here we can enter however we want to. We can enter on this order block that I'm spying here, right? You can wait for the break of this level here, the break of that level here, however you want to trade. This isn't more of an entry model. This is more of a filtering model for whether or not the pattern is mature. And the filter criteria is, has there been inducement? Yes or no? Okay, that's a very, very important filter for me. If we look at US dollar, Canadian dollar, right? Remember trading a couple of these zigzags along the way. This one stands out. Inducement here. Here's the pattern, right? So again, whether you want to enter on this order block down here, okay, now whether you want to enter on this order block down here, whether you want to take the break of this level here, whether you want to be ultra conservative, wait for the high to go, doesn't matter. The point here is, can we filter the zigzag by looking at inducement? And the answer is yes. So what you'll see sometimes, I'm looking for like a really, really strong run in price where you just don't get inducement. Okay, so this is a decent example of a trade that I would pass on. Not least of which is because I can't really count it. Actually, no, there is inducement here because this is the last swing low before the high. Sorry, folks, bear with me for a moment. Okay, let's pretend that we go back here. It's this candle. That's all you see. And then you get a zigzag. Would I feel comfortable trading that zigzag? No. Why? Because there's nothing to induce here. If I'm looking to buy, I need to think like, how can I sucker some bears to get in here and try taking a shot at this trade? And by looking at the single candlestick, does that look bearish at all to you? No, it doesn't. So on the one hand, you say, well, if that doesn't look bearish at all, wouldn't you just buy? Well, the answer is, I need to know where to place my stop. Do I place my stop down here and then, compromise the risk reward? Do I wait for a better entry? My answer personally is I'll wait for the better entry, right? So I would want to see some inducement. So just make sure that is my one key filter for these patterns to measure their maturity is, has there been inducement? Here, there was inducement right here. Okay, so you can see there was inducement there. We look at crypto. Okay, what happened here with Chainlink? Is this a 5-wave move down or a three-wave move down? Debatable. I'm probably inclined to say this is a 3-wave move down. This is likely a 4th-wave triangle. But what do we have here? This is inducement. Why? Because actually, technically, I mismarked the chart. This is our inducement. Why is this our inducement? Because it's the last major swing low, last major swing high before we make a new low. Okay, where's my order block? Order flows up here. So as we tap into this zone here, it's far more likely that we're going to be headed lower. Right? If we zoom out a little bit, we can see this on display over and over and over again. The exact same phenomenon, right? We'll see this time and time again. That doesn't mean it's going to work 100% of the time. Nothing does. But the key concept of inducement is what's so important. Let's look at this wave 2. Well, this wave 2 took out this low. It took out this low as well. It's grabbing all this liquidity here, and then that's going to give us the fuel for that run higher. Wave 3. Was there any inducement? Well, from an Elliott Wave perspective, this is likely all part of a larger, more complex WXY. But if we're looking strictly at swing highs and lows, yes, we have inducement right here. Why? Because this low led to this high. And then if we wanted to get even more refined, we can say that we also have, this is actually a primary inducement here, because this is actually the most recent swing low before we get that high, right? So that is a very, very, very good filter to assess whether or not the pattern is mature. So Pat, just looking at your question, does this have any correlation with volume on the order flow? It does. I look at level 2 data sparingly. All right. So I'm more comfortable using my eyes looking at the chart, but you'll have other people use volume footprint tools. They'll just look at straight up volume. They'll look at open interest. You know, all these tools are measuring the same information in different ways. Because I'm trading on 1-minute charts right now, I don't really have the time to cross-reference multiple streams of data. So I'm just going off of the candlesticks person. Final example with crude oil. All right. Here's my inducement. Here's my order flow. Now, look, I can easily say, and you would be rightfully right in saying this, isn't there an order block here? Isn't there order block here? The answer is yes. Okay. So why am I using the one near the extreme of the move? Because that is the one that is highest probability in terms of working. Okay. That is the one that is consistently been the one that's highest in probability. So I'm going back to the very start of the move and I'm looking for order flow there. Right. And if we don't get the move all the way up here, let's say the move comes to here and starts fizzling out, that's where I'm going to start using my typical Elliott Wave entry models. Okay, so I'm really, I'm hoping that prices tap into my order block because that gets me the best risk reward, right? So on a swing trade basis, you know, I'd be looking at this, right? Even if I entered on a swing trade basis, you know, I'm still up 130% on this trade and I could manage my risk, right? But how I'm doing this is I'm looking at higher time frame pieces of order flow, and then I'm using the lower time frame to trade it, all right? So for example, here's my inducement. Unfortunately, this trade didn't get triggered because I was looking for this, didn't get triggered. No sweat. I have another shot. Here's my inducement. Actually, that's not quite inducement. We make a double bottom, but we don't make a new low, all right? But the principle still remains the same. Do we have a single candle order block? Yeah, we do. We have this up here. Okay, this would have been a phenomenal trade. I wish I could say I took it. Here we have inducement again. This would be our order flow, and this one doesn't get tapped into. It does over here, whether or not, you know, you're sticking around for that limit or not, order or not, I can't say. And then here we get another series of breakdowns. Here's inducement. As you can see, we don't go up to the extreme, but we get some really nice Elliott wave patterns here. Whether this is a triangle, A, B, C, D, and E, 1, 2, and then 3, or you want to see this as a messier zigzag, A, B, and C, that's fine. There's still entry models galore, all right? So this is just another way of getting into the market when you don't really have a good plan A that's available to you, all right? So the most frustrating ones to me are when you get a zigzag. So this is my impulsive advance, and you get a zigzag that looks like this. And it's like, well, you know what? It doesn't make sense for me to put my stop down here and trade it like that. You know, so in a situation like that, what am I hoping for? I'm hoping for inducement. You know, and I'm hoping for either a fair value gap or an order block somewhere down here that I can utilize for the trade. And now my risk reward proposition is dramatically improved. Okay, so like I said, this one, we're not going in depth into all the details in terms of how to draw order blocks or inducements. I just wanted to introduce you guys to my current trading style and what's changed a little bit there. So if you have any questions, we've got a couple minutes till the top of the hour. Feel free to jump in. Otherwise, we'll end the webinar and then I can take I can take questions in the Discord channel. So I have a question from Thomas. So strategy is figure out the higher trend, identify inducement, identify an order block or flow, set the order on the order block. Yes, that is broadly correct. That is broadly correct. So I'll make a little bit of a tweak here, okay? Because nothing that really changed from the fundamental parallax trading plan, which is one, identify trend. Two, market structure / pattern. So whereas before step 2 stopped at what's the count, you know, I'm adding now here, what's the count plus ID inducement and order flow. Unmitigated order flow to be precise. And then step 3, momentum. That hasn't changed. 4 hasn't changed. Time frame entry, stop loss, and target. So the only thing that's really changed is this additional filter of where's the inducement and where's unmitigated order flow. That's the most important thing. All right, guys. Homework? Yeah, okay, so the homework is play around with this for the time being. Because I haven't gone into the granular details of how to identify order flow and order blocks, I don't want everyone to get too carried away with this right now. But what I would say first homework is start at least examining the charts you regularly look at using these new concepts in mind and see if there's something there. And if you feel like there's something there, and if there's a lot of general interest around this, we're going to have the next follow-up webinar, which is going to delve into a lot more details and refinements in terms of how to identify order flow, what makes order flow valid or invalid, how do we know if it's been mitigated or unmitigated, stuff like that. But yeah, all right, thanks for watching, guys. I'm gonna run off now and talk to you soon. Thanks for hanging out. Always appreciate you spending the time with me. Bye, guys.
Thank you, Emma.
No problem, Thomas. Always a pleasure.
Thanks, Emery.